if I have to summarize why my view has become more bullish as opposed to having been bearish for, most of the last couple of years, I think it's because the economy actually had been slowing and decelerating for the past 2 years. And finally, we are at a point where most of these policy headwinds are over. Policy uncertainty has diminished. The Fed is ready to cut. Fiscal is also turning positive next year in terms of the impulse. So all three major economic force that's shaping the economy is turning in a positive direction. So I think that that is one reason why I think the direction is an acceleration in economic growth from here on.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Much concern has been raised of late about how the economy is slowing and recession risk is rising. But is that really true? Or could we already be through the worst of things with the economy strengthening from here? To find out, we've got the good fortune to talk today with Dr. Anna Wong, Chief U.S. Economist for Bloomberg Economics. Prior to her current role, Anna also worked at the Federal Reserve Board, the White House Council of Economics Advisors, and the U.S. Treasury. Anna, thanks so much for joining us today.
Always happy to be here, Adam.
Thanks, Anna. I know it's been a busy week for you, so thank you for making time for this. Why don't we get to the heart of the question I just mentioned there in the intro there? There's been a lot of concern about the economy slowing down, whether recession risk was rising back up. We obviously had a lot of fears throughout the year that inflation was going to pick back up with tariffs and other things. We have been seeing the job market weaken to the point where the Fed has basically cited it as its reason for blinking and starting to cut rates again. It does not look like we're going to get the latest BLS jobs data this week because of the government shutdown, but we did just get, I think, the ADP report, which came in at negative job growth. So, there's an understandable scope of people out there that are worried that the economy is slowing down. You may have a different opinion. So let's start there. Do you?
I think Adam, as you know me, that the way I read the data is I read it as there's a straight up read of the data. You mentioned the negative ADP this week, which everybody is really focused on because there won't be an official BLS report. And when you look at these data, it would look like that the labor market is falling off the cliff. But that's the perception. But there's also the piece that I put more focused on is we just accept that things are not measured always accurately in the world. You try to understand how these things are being measured, and you adjust for what you think are the measurement errors, and you get to the underlying what's really going on. And I think after I do all those adjustments, I think what it is at the end of the day is that I think the worst uh, deceleration is over, and we are kind of in that right after the worst, kind of where the economy is trying to recover, is recovering somewhat, but it's still a very fragile kind of recovery. And looking forward, I mean, if I have to summarize why my view has become more bullish as opposed to having been bearish for, most of the last couple of years, I think it's because the economy actually had been slowing and decelerating for the past 2 years. And finally, we are at a point where most of these policy headwinds are over. Policy uncertainty has diminished. The Fed is ready to cut. Fiscal is also turning positive next year in terms of the impulse. So all three major economic force that's shaping the economy is turning in a positive direction. So I think that that is one reason why I think the direction is an acceleration in economic growth from here on.
Okay, I want to dig into all that. I'll give a nod too that I'm hearing some similarities in what you're saying. with Michael Kantrowitz from Piper Sandler, who I just had on the channel here like 2 videos before this one. So it's interesting, maybe pattern now I'm beginning to see here. When you say the fiscal impulse is going to turn more positive next year, are you talking globally or are you talking US only? And if you're talking US only, tell me why you think the fiscal is going to get bigger than it is right now.
Yes, I'm talking about US only. So it is the uh, rate of change in the deficit that drive GDP growth, right? And that rate of change is that the deficit is going to get bigger next year from the one big beautiful bill. So outside of the extension of the Tax Cuts and Jobs Act, there are additional things where the one big beautiful bill is actually expanding the deficit. For example, the no tax and tips, or the mega baby accounts, or no tax on retire certain purchases for retirement retirees, and so there are, and a lot of these stuff will happen through tax rebate in April. So next April is where, well, people suddenly have more cash,
Hmm.
and then also at this point, the stock market is creating a positive wealth effect for the top 20% by household income in the U.S. economy, and those are driving the consumption, the spending. We just saw yesterday that the car sales number is really strong, exceeding consensus expectations. That is just not something that a recessionary economy does. In fact, I can list a whole bunch of stuff which I'm seeing in the data, which is not how a recessionary economy behaves. So,
All right. I definitely want to pull that thread, but real quick, just a question that maybe some others are wrestling with the way I am. So yes, fiscal spending stimulates the economy. It comes with its own costs, though, right? Unless you truly are from the Dick Cheney school of economics, where that deficits truly don't matter. Um, so more deficits equals good news next year, and kind of what I'm hearing you say. Where is a line where too many deficits become a bad thing?
I think the line is where there's no foreseeable end to it, to this fiscal spending. So this bill, one big beautiful bill, the scoring of this bill has been controversial, right? So if you look at the entire plan, the Republicans says that the spending part of this bill will be front loaded between now and 2028. And most of the part where they're taking away the funding to pay for this front loaded spending and tax cut is in after 2028. So when you score across the 10-year period, which is how CBO scores it, it actually is paid for by the tariff revenues. So as a result, when the market participants look at this and they look at the tariff revenues, they're like, ah, it's paid for. And so they're not as alarmed. And that's why you see the longer end of the Treasury yields, they're not blowing out in response to the one big beautiful bill. If anything, the longer end of the yield curve has been dropping in the last couple of months ever since this bill has passed, because clearly the market is troubled by other things, which is the cyclical slowdown, the perceived
Mhm.
cyclical slowdown of the economy. And that so the behavior of the longer end of the yield curve are still more influenced by short-term behavior of the economy as opposed to worries about fiscal sustainability.
All right. So is it, I'm wondering if it's too early for you to say definitively, but did Trump's gambit work? Hey, I'm going to shake the global trade chessboard and I'm going to put tariffs on everybody and I'm going to push this big bill through and I'm going to ask to get rid of the debt ceiling and all that stuff. But trust me, everybody, it's not going to be inflationary. We're going to, it's going to pay for itself. It's going to boost the economy. Does it seem like maybe that's actually starting to prove out here?
Wow, you're putting me on the spot right here, Adam. But
I
So
know. Well, I know. Sorry.
for your long-term viewers, they probably have heard me say that in the very beginning that I didn't think that the Trump tariffs would be as inflationary as most people think.
Hmm.
I also think that most of it would be absorbed through profit margin. And I also thought that the one big beautiful bill would be paid for by the tariffs. So I have said all that before. So in that sense, I'm not surprised, but I know the consensus have been surprised by this. But at the same time, I would say that I would offer more nuances to whether we can definitively say that Trump scam bit has worked. First of all, tariff pass through, just because firms have tried to pass through those tariffs and have failed now that they're offering discounts this year, doesn't mean that they won't try to pass through again when the economy is in better shape and they have
Right.
more pricing power. I think the part where many forecasters miss is to think of tariff pass through as a static one-off thing, which is like regardless of what's the condition of the economy. My argument has been the economy has gone through a significant contractionary income shock in the last 6 months. There's no compensating, offsetting positive demand shock, just negative demand shock. And as a result, firms don't have pricing power to pass those tariffs through. So suppose now the Fed is cutting rates, and if Steve Myron has his way, the Fed will keep cutting. And in this case, the economy will do a V-shaped recovery, I think, because there are still a lot of pent-up investment needs. And this is coming from AI related stuff, but also a lot of small to medium-sized business also are they also have not been investing in the last couple of years, and there's just a lot of pent-up needs to do this. So once interest rate falls and uncertainty falls and there's fiscal a tailwind, I think this is where you'll see that firms' pricing power will return again next spring, and then they might try to pass through again. So not it's not just we're going to see a V-shaped recovery. I also suspect we are going to see a V-shaped inflation contour along with this recovery, just because there's also pent up needs to pass through, and it could be that we will be seeing some of that next year.
Okay. There'd be a ton of threads I want to pull here. I'm trying to figure out which one to pull first. So you said a V-shaped economic recovery. I have also seen in some of your recent tweets that you've said it'll be a V-shaped economic recovery or a K-shaped economic recovery. When you say K-shaped, are you talking more sort of like Michael Kantorowicz, a bifurcated economy? Part of the economy does real well, but the
Yes,
other part doesn't?
yes.
Yeah.
Yes, and I apologize for this cape shape, unintuitive characterization of it. Yeah, what I just meant is a bifurcated. You have some that are going V shape, and you have some that are just sputtering around.
Okay. And back to the V shape, not only do you see that potentially happening in the economy, V or K, but you see inflation basically picking back up next year for the reasons you just
Yes,
mentioned.
yes.
Okay. And there will be implications for the bond market for that, correct?
Uh, Um, I will have to punt on that one because I think
Okay.
it's more complicated than that, and I'm not a bond strategist. So I will just I just think that it's true that inflation will come. I would think that inflation will be on a, rising through three. Core PCE deflator will be rising through 3.1% through next year. Um, I think whether that affect how bond traders price things is in their interpretation of whether this is a transitory increase in inflation, as the Fed seems to be becoming more inclined to view it, Or has that increase in inflation be just reflecting uh, an anchoring of inflation expectations? If it's the latter, then bond prices will fall to reflect higher yields in the longer term. But if 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 it's they see it as transitory, they would just wave it off.
Okay, and maybe let me ask this question a little bit more specifically. So, not everybody, but a number of the people I talk to think that bond yields will come down next year, either because they see the economy continue to slow, so they don't see the same V-shaped recovery that you see, um, and so it'll just be, slowing economy and whatnot, and that'll be disinflationary. Um, so, and then you also have the administration kind of trying to do everything it can to get borrowing costs down as well. So I guess my question for you is do you think what do you think the odds are of bond yields heading sub 4 down into some level that the administration would like to see them at? Would they be challenged by this V-shaped bounce in inflation?
Yeah, I think it would be driven more by growth, how the market perceive growth. And if most, so now that many market participants are having more doubts about BLS data,
Hmm.
um, everybody is taking a more holistic look at the macro data, right? So we have in Bloomberg Economics, we have a growth surprise index that takes into 66 indicators to look at the direction of economic surprise. So I think that this economic surprise index is going to keep moving up. And what that means is that as long as that happens through next year, everything else is moving up. I think the market would probably uh, believe that in fact growth is still the U.S. economy is still growing at a at potential pace or even higher than potential pace. There, there'll be one outlier though, in my vision of what happens in the next year, which is the labor market data. So you
Hmm.
could have very uh, great growth data, but you could have a jobless recovery. Recall we have had jobless recoveries before. 2008 was a jobless recovery, 2001 was a jobless recovery. And I think part of the reason why this recovery is this K shape where it's bifurcated is on one hand, in the labor market, what I'm seeing is that big firms are not hiring. They are fixated at boosting productivity. They want to do cost cutting to free up resources to invest in the next generation of technology.
Hmm.
So big firms account for a large proportion of non-farm payrolls. The survey that provides that calculates the BLS non-farm payrolls has over 60% of large firms accounting for the payrolls, right? Whereas in and so as a result, if large firms are not doing much hiring, you could see this in the aggregate number. But what I'm also seeing is that small to medium-sized firms are now hiring. And so tomorrow we are not getting the our usual September payrolls from BLS. However, I can see that we are seeing this bifurcated pattern in terms of hiring. And what that means is that productivity is also improving significantly at the large firms level. And with the small to medium-sized firm, they're hiring I think suggests that there's some early cycle dynamics happening. These small
Hmm.
to medium firms have really had a very tough time the last 2 years. They also were not really able to hire back in 2021 when the labor market was really, really tight. Only the large firms then were able to hire. And so now that the labor market is loose, the small and medium firms are coming in. And I think that that represents that they do have a more optimistic of prospect for the future, and that's why they're hiring today. And that's why I think that's one sign that I'm seeing of this early cycle dynamics.
Hmm.
And so you could actually have, given that given that it's the large firms that's not hiring, and that leads to productivity boost, you can have a situation where growth is great, labor market numbers are not great. However, stock market could keep going up because this means that the large firms' profits are going up, and you could have inflation going up despite the productivity boost because this is a service-oriented economy. 75% of CPI is related to service. And when the stock market is doing well because of the productivity boost from the large firms, the top 20% by income would be spending, and that is what drives CPI up.
Right. Okay. Gosh, it's hard not to hear this as if you're somebody who's been frustrated by this K-shaped recovery that we've been in since COVID, it's hard not to hear this as sort of like the beatings will continue until morale improves, meaning the top end of the K is just going to keep doing well and better, and the bottom half of the K may not, right? I mean, it's nice to hear that maybe these smaller companies are starting to hire here, but if these other companies do great, if inflation still picks up, that's going to be felt much more so by the bottom part of the K, and those folks don't own a lot of assets that are getting overinflated. So do you have any concerns that, yeah, this might look great on average for the economy and the stock market, but on the median level, we're still, falling behind?
Yeah, and so the way I would document what happened to inequality over the last 5 years is that I think the pandemic was actually a great flattener because of the fiscal and the fiscal spending, the American Rescue Act, CARES Act, all those fiscal stimulus during the pandemic was to give the bottom 50% more money, right? So in the first 2 years of the pandemic, in fact, inequality decreased because the the people in the bottom half are getting more transfer, and I think that that's really the core differences between the policymakers who think that government spending through increased transfers is great for progressive ideals because you are giving more money to the bottom, raising minimum wage and giving stimulus checks, child care credit, all that stuff. But I think what it showed is in the long term, all those policies become inflationary. And this is what
Right.
we start seeing in post 2022. So I would trace today's the sticky part of the inflation that's related to services uh, um, to that, those policies from 3 years ago, from 5 years ago. And right now, um, so now after a temporary truce in rising inequality because of the pandemic, now inflation has been biting, and that is a very a force that tends to worsen inequality because here then the real income of the lower 50 start to see erosion, right?
Right. And
And
sorry,
I
sorry
think
to
it's
interject, but just to add that
yeah.
not only have we seen inflation and cost of living, but we've seen price inflation in financial assets. So as much as the bottom half has been getting hurt by the cost of living increase, the top half has been getting lifted by the asset price inflation.
Only after 2022. See,
Yeah.
so there's a story. So after 2022, the asset prices start inflating again because the Fed is close to finishing with this tightening cycle. Recall in 2022, stock prices fell by 20% when the Fed
Yep.
started, right? So before the Fed started raising rates, it was great for this bottom 50, and after that, it was not. And whereas the top income bucket people start to experience asset inflation. I think this 5 years is a lesson for policies, many policies with good intentions of transferring money to the bottom ended up hurting them. And because what needs to happen in order to quash inflation is that the Fed needs to raise rates, and if the Fed in this case also is having good intentions too. I mean, 5 years ago, the Fed changed its framework to now include inclusive full employment, right? And by inclusive, it started targeting these uh, uh, minority populations, their unemployment rate and all that stuff.
Mm-hmm.
And that's why they decided they need to run the labor market hot. But now we have seen that when you run the labor market hot and there's overall inflation, it actually hurts the people who they're trying to help in the first place. So I think both the Fed and the federal government, the direction of the fiscal spending of the federal government, ultimately backfired, and we have seen fully the consequences in the last 3 years.
Kind of proving Reagan's point of the most dangerous words to hear. I'm from the government and I'm here to help.
I felt scared when you just said that.
All right. So in talking to Michael, kind of like you, there's a lot of similarities. He's seeing some green shoots in growth, and I do want to acknowledge that the date we're talking, the Atlanta Fed GDP now estimate for Q3 is like 3.9%, right? I mean, that number will bounce all over the place, but it's looking good so far. He said inflation is moderating, which is good, and that rates are poised to continue to go down from here, especially at the short end with the Fed cutting. And he actually says that he's sort of saying these are becoming Goldilocks conditions for a recovery. And he said one of these Goldilocks elements is actually the weakening jobs market. He said if the jobs market is weak, that provides the Fed with air cover to come in and cut rates, and that will be stimulative to the economy. And as long as the job market doesn't get too weak, right? Then it should be good, right? And the other factor he added in here too is low oil prices, which undoubtedly have been helping the situation. Do you agree with his point there about like enough weakness is good, quote unquote, good for the economy in the job market as long as it doesn't get too weak?
Yeah, I read Michael's note last night, and that he just recently put out a very insightful note, looking at historical episodes where the unemployment rate would rise with stock market. Because the question is, can the stock market keep rising when the unemployment rate is rising? And most people have the most recent recessions in their mind when they thought about it, 2020, 2008, and 2001. And based on those three, you would think, no, the stock market would go down if unemployment rate goes up. But Michael showed that, in fact, there are many other historical episodes where the unemployment rate would go up, even as the stock market would go up. And I looked at those episodes that he identified. And what I found most interesting is that those episodes are the so-called soft landing episodes, or the ones where, so this is what you probably mean by Goldilocks. How Goldilocks can the labor market be in order for the stock market to go up while unemployment rate is also going up.
Increasing, yeah.
And those episodes include the 1950s, the 1960s, the early 1970s, and 1982. And the commonality of those episodes is the lack of resolve of the Federal Reserve. And so basically, the Federal Reserve in those episodes didn't finish the job in quashing inflation. They just kind of like raised it, but the labor market started weakening. They immediately start cutting rates. And in fact, even the 1982 one, you would think that, well, Paul Volcker was at the helm of the Fed. So how is it that, in fact, why isn't, why is the stock market going up? Because even in recall that there was a double dip in the early 1980s. The first time around in 1982, Paul Volcker saw that the labor market is deteriorating, and he wavered. And so that recession was cut short really quickly. And it's only later on where inflation flares back up that he decided to go, really all out, right? Right. So I think that today's Fed is behaving very similarly as those episodes that Michael Cantrell has identified as where unemployment rate would go up with the stock market, in the sense that today's Fed seems to be kind of relaxed about the inflation target. The Fed is supposed to be targeting 2%. They have been off the target, above the target for almost 5 years now. And according to the projections, they would be above the 2% target even out to 2028 for 8 years. And as you could see in their behavior recently, the labor market deteriorated a little bit and they're immediately jumping into action to cutting rates. And so I think that, so my own estimation of the Fed's reaction function is that they have shifted in a dovish direction, is as if they're targeting 2.8%, as if, I mean, acting as if they are doing that instead of the 2%. So I think there are, in this sense, a very important piece of uh, that can govern the macro direction in the next year is what the Fed will do. And given the more dovish shift in reaction function, I think the Fed will accommodate the labor market. And so there's a likelihood that higher likelihood that Mike's optimism is well placed, I think,
Is well
based
placed.
on the read on the Fed alone.
Okay. And let me ask you this. One might say, well, look, if the economy is starting to strengthen, then why are we cutting into that? Why don't we let wouldn't that maybe in danger of eventually getting the economy overheated and returning inflation and all that stuff? I did hear you say that this is sort of a fragile economy here. So I guess my question for you is do you think the current Fed approach strategy to cut from here is appropriate given the conditions on the ground?
I think given what they're seeing in the data, they might feel like they should do this because we just got a negative ADP data, right? A negative 32,000, shockingly weak. And the last 2 months of NFP from BLS also have been surprisingly weak. So based on what they're seeing, I could see why they probably want to buy some insurance with cutting. And also it fends off some political heat from Donald Trump, right? However, if going to the point that I made at in the beginning of this podcast, I mentioned that if you adjust for the measurement errors, what I'm seeing is that in fact things are looking better than what the ADP is suggesting,
Right.
and that there is actually some rebound. So I'm seeing the momentum of the labor market actually improving. And I'm seeing also that there's a lot of pent-up AI related investment that needs to happen the moment that the Fed lowers interest rate. There are just a lot of impulses that's been bottled up. And, going back to 2021, that was also what I saw back then. The reason why that inflationary wave came so fast was because there was actually a lot of bottled up stuff before the pandemic, that bottled up demand that wants to happen. And so hence it was so inflationary.
Okay, but just to ask my question again, um, is it a, I know you think from their own point of view, the Fed thinks that their strategy is appropriate, but from your point of view, in terms of a recovery economy that should continue to strengthen from here, is cutting warranted right now?
So from my perspective, is different than the Fed's perspective, only because the Fed has also need to be mindful of its institutional independence, right? So the Fed's risk management objective, while they wouldn't admit it, probably incorporated some considerations of political independence.
Hmm.
And so whereas from my perspective, I I'm just thinking if I were purely based on what I'm seeing in the economy, and what I'm seeing is that if they cut very sharply, the inflationary pressure will flare up. So it's
Hmm.
not appropriate.
Okay, great. That's where I was going. Thank you. All right, let me I want to ask about, what are some curveballs? Like what are given that maybe growing optimism, are there curveballs you're worried about that could derail this? But before we get there, I want to pick up a conversation that we had, I think the last time you were on, because I've cited it an awful lot, and I'm curious if your thinking on it has shifted. Um, I remember, and correct me if this memory is incorrect, but I remember that you were kind of concerned about the implications of the student loan debt going into repayment, because that's the one kind of debt you got to pay. You decide not to pay it, the government's just going to take it out of your wages,
Mm-hmm.
right? And a substantial amount of borrowers out there, a substantial amount of them clearly can't even repay these things right out of the gate. And we saw delinquency rates shoot up, right? And we're going to see defaults start to shoot up as a result of that. But we're seeing this danger of sort of a contagion spreading into other types of consumer debt, right? As you rob from Peter to pay Paul. Okay, I had to pay the government my
Yeah,
student
right,
loan.
right, right,
Now I
right,
can't
right.
quite, now I'm going to be delinquent on my auto loan or my credit card loan, or maybe even starting my mortgages. So we were kind of in the early days of that repayment process. We're further along now. Um, what's your attitude on that now? How big of a concern, if at all, is it for you?
Yeah, I think it is a concern because but whether it has devastating macro consequences, that will more than offset the positive impulses of the economy, I am not so sure. This is the K-shaped recovery, right? You have
Hmm.
this student loan borrowers, which tends to be most of those debt is, I believe, in concentrated in the age group in their 30s and 40s, the sandwich generation.
Hmm.
Uh, the ones that are going delinquent, particularly, are those who didn't finish the college degree, so they borrowed funds but didn't complete it. Those are the ones most at risk of delinquency. And so I think that segment of we calculated that that segment uh, probably would shaved off up to point at most 0.8 percentage point from personal spending, PCE, personal consumption expenditure.
Hmm.
But what we are seeing offsetting partly that is this wealth effect from the continued stock market um, um, rally, right? And the we just got some new auto purchases data yesterday, very, very strong, which suggests that uh, those people who are benefiting from the wealth stock market are actually filling the gap on those people who are pulling back and spending from student loans.
Okay, so you've probably seen the same charts I have of, like, the top 10% is makes up about 50% of all consumer spending, and then the bottom, I don't know, the next 20 to 50% makes up the next big chunk.
Yes,
And then the remaining 50, remaining 60 or whatever it is, pretty small percent. I hate to
yes,
say.
but I think the issue that one should be concerned about is from the financial stability perspective, which is that of these loans, suppose that the delinquency spill over to credit cards,
Yeah,
and or it also spill over to manifest itself in some bankruptcy of some non-financial firms that turn out to be carrying all these consumer debt in their balance sheet, and those consumer loans in terms were repackaged into other type of uh tranches of loans, kind of like
right.
2008, right?
Yeah,
that
that's
that
the
you
contagion
don't
I was referring to. Yeah.
Right, that you don't know where these bad loans are until they turn bad. Because I could not tell you which corner of the financial system are these exotic things in. And until then you realize, oh, there's contagion, right? But in terms of a macro, how whether directly are they a macro headwind, it's not obvious they are. Only if it becomes a cascading financial stability issue, which is hard to tell a priori. That's the job of bank supervisors. Until then, I would just say my baseline is so far that is not having a visible impact on macro aggregates.
Okay. All right. That's good to know. And again, just to make sure I heard you right, it sounds like that top 10%, top 30%, whatever, they're increasing their spending enough. Um, because of the wealth effect, that it's making up for any reduced spending of the really strapped people below the line. So you're not seeing it as a macro threat, like you said, but you're open to the fact that there could be a credit risk if some of these lenders get overextended, and then we find out that people who depended on them are exposed as well. But we won't really know that apparently until the bodies start floating to the surface. Which, by the way, we did have a couple recently. We had Tricolor and
Yes.
another firm, right?
Yes, yes, yeah. And also, Adam, at the end of the day, I think the most important driving force of the economy is the policy, right? Even if there's a credit event, what matters on whether that will spill into a hard landing event is the reaction of the Fed and the Treasury or other policymaker. If the Treasury bails them out, if the Fed unleashes liquidity lines, so to backstop the frozen credit in the market,
Mhm.
no problem. So it's really about the policy response.
Okay.
And
And sorry, so sort of
right,
like what we saw with Silicon Valley Bank and the other banks that failed, right?
exactly.
A very
Right.
swift response, right? Yeah.
Right, exactly. So if the Fed is very ready to step in, no problem.
Hmm. Okay. Of course, it's hard for people not to hear that and just think, okay, too big to fail, and bailouts for anybody that was a bad actor is just going to continue to be business as usual.
Yeah, by the way, I'm not saying I think what the Fed is doing it would be right. I'm just saying as long as they're doing that, then you could keep seeing this party go on and on.
Go on. Okay. All
And
right.
and I
Go ahead.
and Adam, sorry, just to be
No,
clear,
please.
Michael Cantrell's view that the party can go on, again, let me stress, it's conditional on a very accommodative Fed. If the Fed decides to say, suppose that Donald Trump suddenly appoint Kevin Warsh as the central bank chairman next spring.
Hmm.
Kevin Warsh is a very hawkish person. He's like a persistent hawk, and an inflation hawk. He even was worried about inflation in 2010. So if you have somebody like that leading the Fed, it might be a completely different situation. My baseline is that the Fed will be populated by people who are more inclined to accommodate any labor market weakness.
So that's really interesting. And again, I should remind the audience that you used to work at the Fed, I think.
Yes,
No, okay. Did you work at the Fed? Oh, yeah, you did. You worked at the
yes,
Federal Reserve Board. Yeah.
yes.
Okay. And the Treasury and the White House Council of Economic Advisors. So, you really know systemically how all this works. Um, but yeah, on that point, I mean, I know that Warsh has been one of the lead horses for a while. I don't know if he still is or not. I know that there's a tremendous amount of respect for him, but I would definitely say the storyline right now, the dominant storyline, is that Trump is trying to pack the Fed with, doves and people that'll do whatever it takes to get the policy rate down as low as possible. Um, and presumably, help the administration intervene on the administration's behalf whenever it needs it. Um, I think you said your default assumption is that it'll be a more dovish Fed going forward. But how accurate do you think that current storyline is? Or maybe the other way, what probability do you give Trump maybe surprising everybody and putting in somebody like a Warsh?
Uh, it really it is when you look at the Fed history, it certainly is not at all obvious that a president who tries to influence the Fed by appointing somebody who supposedly is dovish, that person will act dovish. For example, in the 1950s, when um, Chairman Echoes was demoted in favor of somebody who President Truman thought would be more inclined to monetize fiscal debt. Well, it didn't play it out that way. The next two people that Truman installed, McCobb and Martin, turned out to be the father of Fed independence
Hmm.
thereafter. And I believe, do you remember who which president appointed Volcker. Was it Jimmy Carter? I think so. Yes, Jimmy Carter appointed Paul Volcker. But Jimmy Carter was the president who oversaw this whole period of unanchored inflation expectations by pursuing Keynesian policies and a lot of the policies that were very inflationary. And yet he got us Paul Volcker. So I think that if Kevin Hassett were to be appointed the Fed chairman, I right now I think that Kevin Hassett is actually a very open-minded person. He also used to be at the Fed. It's not obvious to me that he's the boogeyman uh who's so loyal to Trump that he would just keep lowering interest rate even though um inflation is flaring up. Um, Similar with Stephen Myron. So Stephen Myron, yes, he has pushed for a very low interest rate recently, but at the same time, from what I've read of him and what I know of his argument, how he thinks in the last couple of months, I also think that Steve Myron is a very intellectually very flexible individual who I mean, they are both there to serve the country. If they see inflation flaring up, I think they will do the right thing. Maybe I'm in the minority here.
Well, we'll see. And, I mean, we even have
I mean,
recent evidence.
to be clear, they might see they Kevin Hassett, Steve Myron, and any Trump appointees, like even Chris Waller, might be perceived as just kowtowing to Trump by pushing for lower interest rate. But the truth of the matter is, there's an institutional bias within the Fed to favor, with a groupthink, to favor uh, Keynesian policies, so policies that tend to be favored by Democrats. And in fact,
Mhm.
as you probably know, the donation record within the Fed is like 95% Democrats.
Democrat. Yeah.
And so it's actually, in my mind, I think it's actually healthy to introduce these diversity of views uh, just to stimulate a debate, right? So clearly, Steve Myron's argument did not move anyone at the FOMC. However, it steered the conversation. It opened up the range of the debate to consider cutting, whereas before there was not even it was like a small range of policies to be considered. Not, but right now he just opened it up, and I think it's a healthy thing.
Okay. No, that's actually really fascinating. And like I said, to your point about sometimes the Fed chair just doesn't do what the president who put him in assumed he would. We only have to look at Trump's first administration
Oh
where he
yeah,
put
yeah,
Powell in.
exactly.
Yeah,
So every time the president tried to put somebody in who they thought would be friendly to the policy, didn't end up that way.
yeah. So okay. All right. Well, look, we're coming up near the hour, so I've got to wrap it up to be respectful of your time. I've got one curveball question for you, but before I ask it, to set the context. Okay, you see a potentially recovering economy from here. Um, what kind of market outlook do you have at this point in time? Does that de facto mean good market next year because of a recovering economy, or will the two perhaps be as less correlated?
Sorry to disappoint you, Adam. I'm not a market strategist. I'm an economist, so I
Yeah.
have to refrain from giving market advice. But generally, I think I agree with Michael Cantrow's hypothesis. I think there's something there.
Okay. And just to refresh people who haven't watched that video, Michael's market outlook is this is all generally pretty good for the markets, and he thinks it's healthy in the sense that he sees a broadening out of the sectors of the economy that are starting to get some love because of late it's really just been the high tech capital investment part of the economy that's gotten a lot of benefit. And now we're starting to see other parts of the economy start to get some sunshine and hopefully fare better from there. So he thinks that in general the market will do okay, but it probably won't be the big tech hyperscalers driving all the growth going forward the way they have for the past couple of years. He thinks they'll probably still do okay, but he thinks the better returns will be elsewhere in the market. It'll be sort of in the lesser loved parts of the stock market that hadn't been getting much sunlight. So the smaller cap stocks and even a lot of the S&P 493 outside of the Mag 7. So he said, you're probably going to find better returns as an active investor next year, investing in these areas that are starting to really recover, probably more so than you will if you just try to ride the existing big tech trend that's been going on the past couple of years. You don't have to agree with any of that, and I just wanted to make sure folks knew what Michael's current outlook was. So let me ask you this then, and it's a market related, but I think you can still have a opinion on it as an economist. So much of the current market valuation right now is around AI. And if you look at the market valuation metrics, a lot of them are at all-time extremes, or close to it, or in some cases, definitely at. And so to a certain extent, were something to happen to the AI phenomenon, that would definitely have a pretty big market implication, and it could actually have economic implications from the negative wealth effect that would follow. And we're seeing, I mean, almost like a week doesn't go by now where somebody who's really high up in the AI ecosystem saying, this thing's in a bubble. So do you have any concerns about kind of an AI correction, maybe sort of similar to the dot-com correction, where it's like, look, we're not saying the internet isn't going to return phenomenal returns over time. It sure did. It just didn't deliver them on the immediate scale that everybody was assuming in 1999 to support those asset valuations.
Okay, I will answer this question in two ways. Number one is, since my specialty is in macro, I'll focus more on the GDP and growth implication. So what we are seeing in GDP figures in the last year is that AI-related investment has supported GDP growth by about 1 percentage point in the first half of this year. So without the AI, related contribution, it would have been, this first half of this year would have been zero, close to zero, right? And so in this, the AI related capex is just this is just the beginning of it, as it shows up in GDP. Last year we didn't see it this clearly. Only starting in the first quarter are we starting to see it clearly. So what we try to answer is, could the AI related capex grow at this current rate? So it has to keep going at this rate in order for it to keep contributing so positively to GDP growth. And the answer we arrived at is likely yes, until next year at least. And why is that? Well, it's because I we interpret the dampening of this AI related sentiment recently as related to people are more clear-eyed about the feasibility of AI and becoming in their AI is not going to be sci-fi, reaching that sci-fi level that people had in their fantasy. It's
Mhm.
going to be much slower. However, the second phase of AI would be the adoption and usage in other applications, right? And we think that this second phase is as data center intensive and energy intensive, can support that level of investment in order to continue to add to GDP. And we are seeing still shortages in data center and electricity power grid. And given that shortage, it means that there's positive incentive for firms to be investing. And so from a macro perspective, we see a case for continued investment related to the infrastructure of AI, right? So that's part one. Part two, in terms of the market, which part of the AI market is huge, right? There's the hyperscalers, and there's a whole bunch of small caps and mid caps who are increasingly adopting AI, right? So is the bubble in the hyperscaler, or are we talking about a bubble in all the AI related stocks out there? And again, I'm not a equity market specialist, but how I would apply economic reasoning and intuition to analyze this question is basically, there is an AI related stock bubble if the profit margin growth of these AI related firms are not on a path for their to break even in their EPS, right? A bubble like the dot-com bubble is one where you see a lot of firms who actually have negative EPS who are not making a profit yet fetching sky high valuations, right?
Hmm.
But right now, what you're seeing in these many of these small caps AI related firms is increasing, accelerating profit margins. So it's not like the profit margins is tanking yet. It's like you're seeing like 60, 70, 80% profit margin. And so they are actually, some of them are on track to break even the EPS. And I think I would I would advise for those who are trying to gauge what stage of the AI bubble, or if there's a bubble, is to calculate the break even of the profit margin for breaking even EPS and look at the path of the actual profit margin of these small caps to medium caps, mid caps, AI related firms, and see whether they're on track or is it really ridiculous.
Okay. Well, it's a great economist answer, and certainly what I take from part of what I take from your answer there, Anna, is there's some there. Question is there enough there to support today's asset valuation prices? But TBD, and do your homework, as you're saying. All right. Well, look, as we wrap up here, is there anything burning brightly on your radar, either as a uh, an opportunity or a concern that I haven't thought to ask you about yet?
Adam, you've always asked the most important questions, so you got it all.
Ah, you're so kind. All right. Well, there is one last very important question to ask you, Anna, which is for folks that have really enjoyed this discussion and would like to follow you in your work in between now and your next appearance on this channel, where should they go?
So you can follow me on my Twitter account at Anna Economist, or you can find our work on the Bloomberg terminal by typing BECO Go, where you can access all our coverage of the global economy.
All right, fantastic. And as usual, Anna, when I edit this, I'll put those up on the screen so folks know exactly where to go. Folks, the links will be in the description below this video as well. All right, well, folks, please join me in thanking Anna for coming on the program and being so generous with her insights by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Um, also, this video will go live on Sunday, and I believe this is the last day that, maybe it's the day before the last day, that the early bird lowest price discount we're offering for our upcoming Fall Online Conference will be available. So please, if you haven't bought your tickets yet, buy them now so you can lock in that lowest price. To do that, just go to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, look for the code that I've emailed you that you can use to get an additional $50 off of that lowest price. But yeah, do it soon because that conference is coming up in just about 2 weeks, and it's going to be absolutely fantastic. Best faculty ever. Lastly, if you would like to get some professional help in figuring out how to position your portfolio to ride the trends of the future, especially if they happen the way that Anna thinks they might from here, then I highly recommend that you get that advice from a good professional financial advisor, one who takes into account the macro issues that we talk about here at Thoughtful Money. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you just like a second opinion from one who does, consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com, and the firms will be in touch with you shortly. Again, these conversations are totally free. There's no strings attached. There's no commitments involved. It's just a free service these firms offer to help as many people as they can. All right. And with that, Anna, again, it's always such a pleasure. Thank you so much for coming on.
Thank you, Adam.
All right. And everybody else, thanks so much for watching.